Okay, thanks, Nigel. Good evening, everybody. Tragedy and Hope, which I've borrowed from Bill Clinton's mentor, Carol Quigley. From my experience in gold, there's been a hell of a lot of that over the years. I think the needle is moving more in the direction of hope now than it has been for a long time. I think central banks are really pushing the current iteration of the Bretton Woods currency system towards its limits. I think as I lay out some of the issues there, the big picture argument for gold, the arguments are becoming more compelling. That said, if you know the gold market, you know that it's not just the merits of the investment case that's critical for the gold price. And what I think is important, I'll talk about towards the end of the presentation, is I think there is a chance that the fundamentals for gold could be reinforced by some disruption to the status quo in London. My starting point, though, is going to be our position in the debt cycle. What I show here is that we're in the fourth debt cycle since the Industrial Revolution. I'll go through a classic debt cycle with you in a moment. Not surprisingly, what you tend to see is a protracted rise in debt until the latter stages of the cycle. And eventually the system becomes overwhelmed by debt. Typically, the final phase of the cycle is brought on by an equity market crash. And in that final phase, in the first three cycles, what we saw was that the debt load was purged by debt deflations. They purged the asset bubbles as well. And I asked the question, will it be different this time? As we look at the current cycle, it is the longest by far, 85 years and counting. The final phase of this cycle, as I'll show you, is heavily distorted. And that's really because of our central banking friends and their hyper-interventionist policies, and the fact that the previous three cycles we were essentially on a gold standard. Let's just talk about gold in debt cycles, though, briefly. It's important where we are because gold has performed very strongly in the last stages of previous debt cycles. What I show you there, what I call the winter phase, the final stage of each cycle. On the right-hand side, you can see the actual performance of gold and its performance in real terms, which is important because they were deflationary periods. And I'd urge you to really contrast how gold performed in particular versus stocks. I think it's pretty clear. And I think as we go into the last stage of this debt cycle, the question to me is, do we, as we've seen before, have a debt deflation which brings this cycle to an end, or actually will it be inflation this time? I have my own view on that. To walk you through a classic debt cycle, what you can see there, you can see that the four phases, the seasons, if you like, the spring phase, the rebirth of the economy as debt begins to rise slowly. The summer phase, the growth in debt tends to accelerate. The autumn phase, and then the crash into the winter, which is really the payback and economic collapse. And then the cycle tends to start again. And what I show you at the bottom is in each phase of the cycle, what really you should buy in terms of asset classes, what you should sell. And you'll see that typically gold does well in the summer phase and also in the winter phase. Moving on, show you what happens to pricing in a debt cycle typically. You may know of this as the Kondratiev cycle. Typically, you have benign inflation in the first part of the cycle, and then you have the inflationary summer phase, which is not surprisingly one of the two phases when gold does extremely well. Then you move into the deflation stroke disinflation phase in autumn, and then finally deflation in winter. Isn't it interesting this time around when the Fed has tried to raise rates and normalize interest rate policy and is already backing off that? Interest rates, they tend to follow prices over that cycle. And as I say, you know, we're seeing what the Fed is doing in terms of backing off. And then GDP growth tends to be very rapid in the first half of a debt cycle, tends to slow down in the autumn phase where we feel good, but we mainly feel good because we're seeing these debt-driven asset bubbles, and then everything goes wrong in the last phase. And I say in that chart, you know, we should be in this deflationary phase. We've had 2 equity market crashes, one in 2000, one in 2008, but really the unfolding of the final phase is on hold because of the central banks. And we're in a situation where we're really stuck because we're seeing a fight to the death, if you like, between the forces of deflation, which is inherent in this stage of the cycle, and then the pushback, the inflationary pushback of the central banks to try and retain the status quo. Deflationary force is pretty obvious. We're now looking at a global debt bubble, almost $250 trillion. If you think about it, debt has a time function because it allows you to bring forward what would be consumption from the future into the present. So debt, in a way, buys you time. And as I say, we've bought a hell of a lot of time. On the other side of the equation is the inflationary pushback from the central banks. Not to put too fine a point on it, this is the heavy hand of central planning. After 2000 and the equity crash, then we saw Greenspan cut rates to 1%. That was unprecedented. He left them there for a year. And then this time around, post the great financial crisis, we've seen ZIRP, NIRP, and 15 trillion created out of thin air by the central banks. And I say, meanwhile, back in the real world, but the real world is, this is the result of central bank policies. We have, in my opinion, serial financial bubbles in assets except gold, mainly stocks, bonds, and real estate. And as we've seen, every time they try to reflate the cycle and extend it, they need more extreme stimulus and they create a bigger bubble every time. My sort of question really is, the central banks, you know, you have to give them their due. They succeeded in righting the ship after 2008. But has what they've done, will it be enduring? Or alternatively, has it really just obscured structural weaknesses, which are very profound? And in hindsight, we'll see that central banks have actually overreached themselves. Now, what I want to do is just explain why I think the task for the central bankers is going to get considerably more difficult in the months ahead, because what you're going to see is the debt bubble converging with a series of factors. One of those is the extended nature of our current economic cycle. So we're just 1 month away now from it being the longest post-war expansion. It's actually almost the longest expansion in just over a century. What you see on the right-hand side as well, it's interesting, we're talking about the debt cycles and how GDP tends to slow as the cycle progresses. You can see that's the lowest rate of GDP growth we've seen in terms of these expansions, because essentially the debt is starting to act like a tax on the growth rate. What are market-based indicators starting to say? One thing that's always worth looking at is the yield curve. So what we saw in December was that the belly of the US Treasury yield curve started to invert on the 3rd of December. It was the 3s and 5s. When we've seen yield curve inversions before, With one exception, which was 1995, we've always had a recession within 2 years. And the ones, twos, threes are currently inverted at this moment. Something else to think about, there's a dollar shortage outside of the US. I don't know if this is something you've looked into, but the top left chart just shows how it was a dollar shortage that really was one of the early signs of the crisis beginning in 2007, 2008, when you saw LIBOR diverge from the Fed funds rate on the 9th of August 2007, and then it all went downhill from there. I'll just draw your attention to the bottom left chart. That is something called a cross-currency basis swap. What it's showing you is if you want to swap dollars into euros, over and above the relative difference in interest rates, you have to pay a premium to swap euros into dollars in this point because it's below zero. And this premium to swap dollars has opened up again. Essentially, there's a dollar shortage outside the States, and it's the Chinese banking system is certainly at risk here. Because what's happening is that regional banks outside the US are lending dollars long and they're borrowing them short in the euro-dollar funding markets. And they keep having to roll over that funding, and because of things like Basel III and risk aversion and things like that, there is less dollar balance sheet on offer. And that is a real threat. Now, it could be, the Fed could quite easily come to the rescue here if it started laying out dollar swaps like it did after the last crisis. But that's an interesting question, because my convergence number 4, where I say, the political and financial order really might have changed in 2016 with the election. So we'd been on this long road towards globalism, and then all of a sudden up pops Trump-style nationalism. And it was interesting, you saw this report in the Telegraph back in January, where the number 2 in the IMF was saying, if we have another financial crisis, will the Fed cooperate as it has done in the past with a Trump White House? Obviously, we've got a lot of trade tensions at the moment, and on the right-hand side, I'm just showing you what's happening to world trade volumes, which perhaps brings this issue into more focus. Anyway, what I want to do now is just show you how 2 factors contributed to the first modification of our Bretton Woods currency system, of which gold was very central in that, and then just ask whether you think things may be repeating themselves, because that's my sense at the moment. So if we look at what happened 1968 to 71, I would argue there was a 2-fold loss in US monetary discipline. The first was in the when deficits started to surge in the late 1950s, and then the second phase of this was when policy cooperation began to break down between the US and other nations in the late 1960s, which was when the US budget deficit spiked again because of the Vietnam War. And what you saw in the end was that France and 1 or 2 other nations broke away from cooperating in the US, and they wanted to transfer their dollars into gold, and that's what broke the gold cap at $35 an ounce, and then we saw that 1970s gold bull market. What I think is interesting at the moment is I would argue that we are going through another 2-stage loss of US monetary discipline. I think the first stage was the response really to the crisis between 2008 and 2015. Since then, we started to see the Fed running off its balance sheet and also raising rates. I think things really started to change, though, in December 2018, where that's the Fed's dot plot on future interest rate hikes, and you saw it start to roll over. So as we went into that December 2018 FOMC meeting, the market was expecting 3 rate increases in 2019, possibly another one in 2020. And as we know, this is all on hold now as the Fed says it will be patient regarding any future increases. And then on the right-hand side, we're looking at trillion-dollar deficits, really, as far as the eye can see, thanks to the administration's tax cuts and heavy spending. Let's come back to gold. I think we have some very positive gold fundamentals. On the left hand at the top, what you can see is that last year we saw the biggest accumulation of gold by central banks since 1967. On the right-hand side, again, was it interesting? We talked about the Fed's capitulation on monetary policy in December 2018. That was the very month where China, after a 2-year hiatus, started buying gold again. Bottom left just shows gold demand, what might be called the Silk Road, if you like, China, India, Russia, and Turkey. And then on the right-hand side, you can see that the premium for gold in China versus the London price has begun to rise again. Having said all that, in terms of big picture, what's going to be critical is the mechanics in the London gold market. And this is, in my opinion, where the tragedy of that tragedy and hope really comes out. So if you look at the gold trading in London, what you have is a situation where actual physical bullion is almost entirely eliminated from the price setting process. Now, some of you will be very knowledgeable about this. If you're not, just very briefly, gold trading in London, which people think of as the hub of the physical market, has essentially been derivatized. So at least 95% of trades are in something called unallocated gold, which is an IOU for gold. It doesn't actually require delivery of physical bullion. What that means is that if you're potentially a seller of gold, there's very little risk that you'll be called on to deliver bullion. So what you have is gold demand, which is essentially diluted by, if you like, a factor of 20. And you have a very elastic gold supply in this situation. And what that means is that the price discovery is naturally going to be biased significantly to the downside, in my opinion. That's just the mechanics of this market. And it's interesting, if you look at the gold price, I did 2007 to 2012 just because someone had done a very good chart on this. What you can see is during London trading hours, that's the bottom left chart, the gold price tends to be heavily skewed to the downside in terms of intraday performance. On the right-hand side, just show you something. It was interesting that in the run-up to QE3, which many people talked about as QE to infinity in September 2012, there was no correlation in the previous 12 months between the gold price and the yen. Now, as soon as we had that massive change in central banks where they started to pump liquidity into the global economy, all of a sudden you saw the gold miraculously pegged to the yen. And it stayed there for a long, long time, right through to the end of 2017. I think it's just interesting, very quickly, to look at the gold bear market from October 2012 to December 2015. The gold price crashed 41%, in my opinion, precisely in the opposite direction to market fundamentals. Very briefly, on the left-hand side, you can see where the biggest fall took place. The lines have faded a little bit, but that was in Q2 2013. Now, the World Gold Council shows the surplus or deficit in gold supply and demand in every quarter since 2010. The biggest deficit in gold bullion supply, according to the World Gold Council, was in the second quarter of 2013, in the last 9 years, which was exactly when the gold price collapsed the most. That is inexplicable. On the right-hand side, rather than using the World Gold Council, I put together 4 major identifiable sources of gold demand. So central banks, ETFs, Indian imports, and withdrawals on the Shanghai Gold Exchange. And you can see the rising trend through that period. Perhaps even more interesting from my perspective, what went very unnoticed was that The UK export data from the Office of National Statistics showed that 2,200 tonnes of gold left UK shores during that period. Essentially, there was a hidden run on the gold vaults in London. And what I do on the right-hand side is just calculate what I think was left in terms of the float of gold that supports LBMA gold trading by December 2015. So if you take the total gold in the vaults, take off the official gold held by central banks at the Bank of England, take off the ETF gold held in London, and take off a little bit for institutions, sovereign wealth, high net worth, etc., you had about 968 tonnes. Compare that with about 5,000 tonnes per day of gold trading in London. And what you can see is that in the absence of the market practice of trading unallocated gold, London's gold vaults could have been out of gold within 24 hours. It got very, very tight, but nobody realised. Now, going forward, there is some hope. I say the growing possibility that the confidence trick in the gold market could become apparent. The reason being that performing that same analysis now, what you see is that the gold vaults in London may be even more depleted in terms of the gold float supporting trading than they were in December 2015. On the bottom left, that's the gold lease rate, so the cost of borrowing gold. What you see is very recently it actually spiked up to the highest level we've seen since, guess when, December 2015, when I think the vaults were under severe pressure. On the right-hand side is the palladium price. So we saw palladium lease rates spike to between 20 and 30% during periods earlier this year. And we saw the palladium price went parabolic. So, you can see what can happen if we get very tight on gold. This is not going to be an easy process, because even if the vaults come under severe pressure, you would expect the official sector, at least initially, to lend to the London market. My question would be, how long would they do that if they felt that they were not going to get that gold back at some point? So what I'm saying to you is we saw a run on the gold vaults between 2012 and 2015 in London of about just over 2,000 tonnes. The way things appear to stand at the moment, we wouldn't be able to cope with a run on the vaults that was half that strength or even less this time. Finally, we know the situation, sadly. The investment community is still not interested, even with, that's the chart of the GDXJ, so the Junior Global Gold Miners ETF. One thing I'd just like to point out, though, this is a curiosity that piqued my interest anyway, is sector M&A and Barrick Gold's recent deals or attempts at deals. This company has very long-standing establishment ties. Just to go back to the last gold bull market, so to give you the date, it was the 25th of June 2001. The gold price was $272 an ounce, so just above the low of 252. Barrick announced a $9 billion merger, if you remember, with Homestake Mining. Fantastic timing. We had a 10-year bull market halfway through, 31st of October 2005. Gold price was $471 an ounce, and Barrick announced the $10.4 billion acquisition of Placer Dome. They have a great track record of well-timed deals, and we've seen them very active recently. There we go, a little bit of hope. Thank you very much.
Thank you very much. Well, a lot to think about, and as to how all that translates into investment strategies, I think could probably be the scope for another entire talk. But any questions finally for Paul?
What do you think for the next 6 months, Paul?
No.
What do you think for the next 6 months in the gold price?
Yeah, I think we're in the early stages of another bull market. Do I think things are going to get, positively out of control from the vault situation? Probably not within 6 months. My hope, to use the operative word, really is I think making specific targets is a mug's game. My gut feeling, and it's nothing more than that, is that I hope when we get beyond the next US election that we have another, we challenge the all-time high again after that election.
And the sort of safe haven buying we've seen in the last few days, I mean, I suppose in some ways that might link back to what you were saying about US policy, central banks and so on, but it's also about trade. Is that semi-detached from what you've been talking about?
No, whilst I'm expecting a sort of a takeoff in the gold price. That's the trajectory is relatively modest from here to begin with. The great thing about, I think, gold at this point is you have it's a series of options at the same time that somebody drops the ball in terms of a trade spat, or for instance the dollar shortage comes comes into focus again, something like that.
Okay, and we've got a question here.
Could Vodafone's 40% cut in dividend today be the trigger for a whole stack of other stressed businesses, and the likes of BT, Centrica, BAT spring to mind, and see a re-rating of the yield on the FTSE, and as a consequence, investment looking for alternative homes rather than sitting back and picking up 8-9% yields?
What do I think? I mean, pressure on yields. Obviously, it's going to make gold relatively, look more attractive. But, is that? I don't think that is going to see necessarily a sea change in global gold, attraction just from specific companies. What I think may be more realistic is and what we've seen recently is. We've got a very extended stock market. If we see jitters in that, then yeah, I mean, it's gold, and it's, look what's happened to the crypto market again. People are looking at those safe havens, but I don't think Vodafone makes a big difference.
I was thinking of Vodafone on its own, that somebody's actually one of the big dividend payers has actually come out and said, right, we're cutting. And there's an awful lot more of the big dividend payers in the FTSE might just use that as an excuse to.
I hear what you're saying. What I think is your average fund manager who is generally very negative to gold, and in the last two gold bull markets, they were massively wrong-footed. It's going to require some real shock treatment, I think, to get them to open their eyes to investing in gold. And I think it takes a severe move down in the stock market, or a severe breakdown in trade relations, something like that, to move your UK fund manager into thinking, hey, you know what, where are those gold companies?
You're not suggesting cryptocurrencies are a kind of digital gold now, or seen that way by some?
Some people do see them that way. I know what I'd prefer to invest in, but I've got a bit of both.
Okay, well, one more question over here, and I think.
Or can I just ask a question, please? Why do fund managers not like gold?
I think it almost, for them to buy gold, I think they have to write off to some extent the economic outlook and a lot of their stock picking, because they feel gold, and even gold stocks, is generally a very passive way, I think, to invest, and really nothing more than insurance. And it takes them an awful lot to drag them out of that. And I think the other thing is that the media and central bankers are almost uniformly negative on gold. And I think, and the fact that, you know, we're so long since we had any kind of gold standard or gold exchange standard, that it's just not part of their, you know, their day-to-day experience. They're not interested.
And a last question over here.
In relation to your presentation, you don't actually talk about, let's say, how do you actually take out things like poisonous chemicals out of extracting gold, like mercury and cyanide? Is there any new innovations which are coming along which are eradicating the use of these toxic chemicals?
No, I mean, I don't know, Mark, if you've got any view on that. I haven't seen, I don't think there's any sea change in terms of gold market technology that's going to...
Extraction, more like, yeah.
That's going to rapidly transform.
I'll just project my voice. The gold, 20% of the gold around the world is mined by artisan miners illegally in the Amazon jungles in Nicaragua and Africa. And they're almost all using mercury. We have the Minamata Convention which bans mercury, but these poor countries use it because there's often no alternative form of livelihood for them. 90% of the world's gold producing mines use cyanide and have the cyanide code and cyanide destruction units. In one way or the other, they're using cyanide either through a carbon in pulp or a carbon in leach mechanism or a merrill-crowe mechanism. Those are the three main. Gravity separation you can use in some types of gold, but it's often only gets half the gold out by a centrifugal crushing, grinding, and a centrifugal force. So although you mentioned they're dangerous chemicals, but actually it's not the listed gold producers who you need to worry about. The Barricks and the Rangolds, or merged new Barrick if you like, they're all signed up to Equator Principles IFC form, and they have cyanide destruction units, on the back of which if water goes into a tailings pond, a bird can often drink off the back of it, theoretically. So they're not the bogeyman that people make them out to be in terms of the extraction methodology. I don't see any change in it either. There's nothing really on it. It's very efficient the way it is.
Okay. Thanks. Any more questions? Just one more. Oh, sorry.
In terms of your figure for the flotation, your 802 to support the OTC trading, how rigorous is it?
Okay, so in terms of that figure, what we get now is the LBMA on a monthly basis produces the total volume of gold in all the London LBMA registered vaults. The Bank of England does the same in terms of its own vault. So what we can do, bearing in mind that the vast majority, and I assume 95% of Bank of England gold is official gold, then we can take that off the total. We then need to make an adjustment for ETF gold. Now that's relatively easy to do in the sense that on an annual basis, each of these ETFs publishes a prospectus. They tell you where the gold is, so we can do that. And I've done that over the years. And what the last time I did it, London-based gold was about 71% of all the gold in gold ETFs. So I use 70%. I mean, you know, I will test it again probably the end of this year, but it's been there or thereabouts. And then you have to make another small adjustment for, as I said, sovereign wealth, high net worths, etc. So I'm reasonably comfortable with that figure. The only problem we have, to an extent, is that the LBMA and the Bank of England are typically producing this data 3 months in arrears, which is very convenient for them and less convenient for us.
Okay, well, thank you very much indeed to Paul Mylchreest.